Okay, so I think this is the first time I remembered, so that we'll actually get a full lecture on the recording as well. Um, and I can go ahead and put up the slides and hope that my machine is not going to make me go through that silly process of putting it into slideshow mode so that it doesn't work and then forcing me to come back out, close the slides, um, and start it all up again. But we'll see. Maybe we'll get lucky for a change. Let's see. Yeah, no, it's not going to do that. Yeah, there's never a rhyme or reason as to why it wants to do that to me. So let me see. And then it locks up. It locks up. Okay. And it seems to like it that I have to reopen the file. I guess I could go through this ritual before class starts. I guess it just, there's no rhyme or reason to it. It's working out for some strange reason. Okay. Your guess is as good as mine as to why I have to go through that. But let me get my clicker and I'll be ready. 1 sec. I think we're ready to go. Yeah. Okay, good. All right. Now, in chapter 2, we're still talking about the structure and content of the GASB 34 basic reporting model. Remember, we have the MD&A's required supplemental information. We have the basic financial statements, both the government-wide and the fund statements, and the notes there too are always considered an integral part of any set of financial statements. And then we have the required supplemental information other than the MD&A. So we've spent some time going through in pretty detail these basic financial statements. But what we're going to do is review a little bit more the fund types, the fund structure, and understand a little bit more about that bottom part of the box, the nature of the required supplemental information other than MD&A. And then do as we've been doing, take a look through the city and county of San Francisco's annual comprehensive financial report to see that it comports, and it has been pretty much with what we learn as we go through the various slides. Now, what you see here is a reminder between what we see in the governmental fund financial statements, where we would make journal entries reflecting modified accrual accounting, versus how we would record the same transaction if it was going to be recorded at the government-wide level, using full accrual, or in one of the proprietary funds or the fiduciary funds, which also use full accrual accounting. Now, again, the way some of our slides present information, and if you've acquired the textbook and you started doing some of the reading in there, they tend to take this approach of showing you the two different ways the same transaction would be recorded under full accrual, say at the government-wide level, versus modified accrual at the fund level. Our understanding has been that what we actually record at the fund level using the appropriate accounting, say for the general fund, we would record a transaction using modified accrual, and then we would convert governmental fund activity from modified accrual to full accrual as we consolidate and convert those fund financial statements into the government-wide statements. We're really going to be taking this approach of showing you the journal entries as though we record them two different ways simultaneously at the government-wide and the fund level here in the first, during first beginning of the class. And then a little bit later, we're going to talk about the conversion and consolidation process. I think it's like chapter 10 or something like that. We'll do that. But that's what you see here. They're recording a piece of equipment, I guess, or a building, I guess it is here. And they're saying, hey, look, if we were recording this out of the general fund or the capital project fund, one of the governmental funds, we would debit expenditure, credit cash. If we were trying to record that, remember, for our government-wide statements, we have both governmental activities and business type activities. For our governmental activities column, we would record it using full accrual by debiting building, equipment, whatever it is, and crediting cash. And then, as we have mentioned, there would be no depreciation at the fund level, but at the government-wide level, and we've understood that City and County of San Francisco uses the required approach and records and depreciates fixed assets, records depreciation expense, accumulated depreciation, et cetera. Whereas for our infrastructure assets, for some governments, they go ahead and use something called the modified approach. And if the infrastructure assets meet certain requirements, then they do not need to record depreciation. However, they do need to require some additional required supplemental information when they choose the modified approach. City and County of San Francisco doesn't do that, but we'll talk more about the rules associated with using the modified approach for infrastructure assets in Chapter 5. Okay, good. So we start to take a look and continuing on with this dual effect of transactions using modified accrual versus full accrual. And remember, there are no fixed assets. There are no long-term liabilities at the fund level. When you acquire a fixed asset, you saw the expenditure. If you have incurred a long-term debt, like you've issued bonds or a long-term note, I think this is a 3-year note here, then you would go ahead and you still debit cash as you receive those funds, but you don't credit a note payable. You would credit other financing sources. And remember, we said with other financing sources, there are two other financing sources. One is long-term debt financing, which you see on the screen here. The other is if there's a transfer into a fund. For example, the general fund, as you're aware, often transfers money into other funds. And if that was the case, there'd be a debit in the receiving fund, and there'd be a credit, a debit to cash, and then there'd be a credit to other financing sources transfer in as the fund receives that transfer. We also talked about other financing uses, and we said those are sort of like non-operating expenses. Remember that? We talked about that. But we said that for that, that's the other financing uses. The only one other financing use is a transfer out. So the fund transferring out with credit cash is they're transferring cash. Debit, other financing uses, transfer out. It's sort of like a non-operating expense, but we don't call it that in governmental. We call it transfers out, other financing uses, transfer out. That's the one other financing use. Okay. Okay, good. And then you can see that same transaction that we had here at the government-wide level. Yeah, we'd use full accrual accounting, and we would go ahead and credit the liability, long-term liability here, note payable. Okay, great. So let's go ahead and let's remind ourselves of our governmental funds. We have the general fund. Much of the activity of the governmental funds rolls through the general fund. That's the biggest fund almost in every government. That's the case in city and county of San Francisco. And so many transactions go through the general fund. I think they're showing this fire person with the fire hydrant, for example, public safety, fire, and police activity generally goes through the general fund. Okay. Special revenue funds are funds in which there is funding being created by a particular government activity. They're showing a road here, giving us the notion of toll roads. We're not too familiar with toll roads here in California. I did some work years ago in Florida, looking at self-help opportunity program for housing. And what they do is the federal government provides a loan at a low interest rate to individuals, and then they help them to acquire a home through these loans, and then they have to pay the loans back at a lower interest rate. But they also put in a certain amount of sweat equity. So they have to come in and they can do some things like hang up sheetrock and do some clearing of the lot and that sort of thing. They can't do things like, they don't allow them to put it, try their hand at installing the electricity or the plumbing or something. They have experts that do that. And the way that program works, not only do I have to help work on my house, I have to help you work on your house, and they find that helps build better communities. Some of the longer term outcomes that we looked at was people tend to stay in the homes longer and whatnot, and that was the purpose of that job, to see how that program was working. But we ended up going to Florida because we were following the dollars. We did quite a bit of work in California, but then there were quite a bit of that self-help opportunity program dollars that went to Florida. And, I'm California boy sitting there, man, every time we go another 15, 20 miles down the road, we got to stop again and put in another toll. I mean, how many times we're going to do this, right? And so those kinds of toll roads, they can be an enterprise fund, but they can also be run as a special revenue fund. And so that's why they're showing a road here. Typically what happens with the special revenue fund is you spend all the money out of a special revenue fund. You spend both principal and any interest. We're going to see the permanent fund here in a little while. With a permanent fund, governments will maintain the principal or corpus, but they're able to spend the interest out of that permanent fund. Again, these are fund categories, guys. So even though there's only one general fund, there could be several special revenue funds. There's typically only one debt service fund. I don't know if San Francisco, and we're going to look at the financial statements a little later. We can see if what I'm saying is true for San Francisco. I'm not seeing everybody today. So if you have some notions of things that are unique to San Francisco that are different from what I'm saying, just chime in with that. But debt service fund, it is there to account for the debt, both paying back principal and interest of the other governmental funds. So remember, when we issue the debt, we debit the cash, we credit what other financing sources, the financing sources is like a non-operating revenues, I've stated, and it shows up where it shows up on the statement of revenues, expenditures, and changes in fund balance for the governmental fund. And so no long-term liability is created, but we still have to pay the money back. So what we do is we create a debt service fund, and the debt service fund's whole job is to accumulate the resources to pay back principal and interest of general obligation debt for the other governmental funds. Most of the time, the money gets transferred over from the general fund. That's why I point out to my students sometimes, hey, when you vote for a government to issue debt for certain purposes that you think are important, keep in mind that ultimately the payback of the principal and interest on that will come out of the general fund, and therefore maybe there won't be resources available for other things that you think are important for the government to be involved in and have some sort of funding for. Years ago, it was in the 90s, there was a big tough on crime push in the state of California. And what happened was they kept passing bond initiatives to issue bonds to build prisons. Well, issuing a long-term debt for an investment to build prisons, once you build a prison, that's pretty much saying you're going to continue to have people to put in the prison. And so I'm not sure that that's the best long-term investment, but that was something that was happening a lot in those days. And of course, then you have to pay back the principal and interest out of the general fund. So you could theoretically have to take money from education in order to pay to, build prisons to lock people up in. And then often these prisons are run by private for-profit entities. So I'm not sure that that's the most productive long-term liability, but the debt service fund would do the accounting to pay for that, but the money generally comes from the general fund. And we'll talk more about the debt service fund in chapter 6. Capital project fund, we want to build some sort of government capital project, a county courthouse, let's say. We will probably issue bonds to build that county courthouse. Again, these are general capital assets that are going to be the possession of the government. We're not talking about building things that would be run as an enterprise fund. We're talking about government buildings and whatnot. And we'd probably issue bonds, and the bond proceeds would come into the capital project fund. And then we would do the accounting of the spending of that money out of the capital project fund. Again, all of these governmental funds using using modified accrual accounting. Permanent fund, again, it is a fund in which we will be gathering resources, and those resources are going to be used to run some sort of government activity, maybe a park or something like that, a public park. And what happens is the funds come in, we maintain the principal on those funds, but we can spend the interest, and that would be accounted for in the permanent fund. So it's fairly descriptive as to what this fund is doing. Permanently maintain the principal corpus and then spend any earnings, any interest off of that principal in the execution of the activity of that permanent fund, whatever it is. Okay, those are governmental funds, 5 types, although we say types, there's really only one general fund. Proprietary funds, there are 2 of them, the internal service fund and the enterprise fund, and then we'll talk about the fiduciary fund types here in a couple of minutes, okay? But our proprietary funds, okay, they're going to use full accrual accounting. So if we purchase some sort of capital asset for our internal service fund, let's say, or for one of our enterprise funds, we will debit equipment, as we saw in the earlier slide, even though I think that was trying to show you government-wide, but same accounting, full accrual. We would debit equipment, we would credit the cash, we would depreciate these assets, and all governments do this now for the proprietary funds. There is no modified approach for proprietary fund assets. The modified approach that we'll talk about in chapter 5 is limited to infrastructure assets, bills, roads, bridges, that sort of thing. It is limited to those sort of infrastructure assets that meet certain requirements. And again, city and county uses the required approach, not the modified approach. Is Carmen here today? I don't think she is. I don't see her. Okay.
Yep.
And
Sorry.
oh, there you are. Okay. I don't know why I didn't see you up there. Okay. And I asked because you had told us, right, that for infrastructure assets, city and county uses the required approach, not the modified approach. But for our proprietary funds, all governments will record depreciation expense, record accumulated depreciation. And when you purchase a fixed asset, you will debit equipment, debit building, whatever it is, and credit the cash for that.
Yes.
Okay, good. Now our financial presentation, and remember, guys, for our governmental funds, okay, I'm just going to go ahead and label this a little bit better using my pen here. For the governmental funds, right? Current assets, current liabilities only. We'll talk more about deferred outflow and deferred inflow later. Okay. Probably we'll really start to get into that and the ramifications of that in chapter 4 next time. But then what? We take sort of the approach that you're all very used to, which you'd see in commercial accounting, which would be what? Assets, although it's only current assets here, equal liabilities plus stockholders' equity. Okay, and we see a total for assets. We see a total for these two. Okay, that's the same thing that we do for our governmental funds. For our proprietary funds, they give them the option of using this approach. GASB does. Okay, so they have the option of using this approach. Most governments would take that option. This approach is required for the government-wide and the fund types. Okay, and since we're on full accrual, it's all assets, all liabilities, the deferred inflow and the deferred outflow. And then what happens is they subtract the total assets plus the deferred outflows, and they subtract from that all liabilities plus the deferred inflows. And the bottom line here is the net position. So if we had, current assets of 100 and liabilities of 40 and stockholders' equity of 60, okay, we would see what? We would see a total line of 100 here, okay? What this approach does is if we have all our assets plus our deferred inflows were 100, then we would list all the liabilities that would total up to 60. And then the bottom line would be this 40, and we would report that as the net position here. That's the approach that is required for the government-wide, for the fund financial statements. And then for our proprietary funds, I think it's an optional approach, or maybe it's a suggested approach, and most governments would use.
Huh? No, I don't know what to send. No.
Okay, let me go ahead and see if I can mute
Your laptop on my bed.
Okay, Tina, do you want to mute? I can mute
sorry.
you too, but that's okay. Just for your own
I thought I
privacy. We don't mind hearing you, but we don't want to hear everything that you don't want us to hear. Okay, good. All right, so let's go ahead and let's take a look. And I showed you these statements last time for our proprietary funds. Notice what we have: our enterprise funds, our internal service funds, both current and non-current items, right? And then we have our liabilities, both current and non-current. And notice here, guys, we end up with what? That total net position. It is the difference between the sum of the assets, right? The sum of the assets plus the deferred inflows. In this example, excuse me, deferred outflows. In this example, oh wait, maybe they did. Maybe it's over here. No, in this example, they didn't have, I pointed to the non-current. I wanted to do the total assets. In this example, though, they didn't have any deferred outflows, okay, which you don't have to have those. And then over here, we have our liabilities and our deferred inflows. So the sum of those, okay, and if you were to sit here and you can play with this and do the total liabilities plus the deferred outflows and subtract it from the total assets, the difference would be this total net position. Now, when we report net position, we have three categories that we report. And by the way, the government-wide statements would use the same format, even though we're down with the proprietary funds here. And I'm focusing on the column for one of the two enterprise funds, but they roll up to the total of the enterprise funds over here. And we saw how that rolled up to the government-wide business type activity column. There's only two, but the two added together was what rolled up to the government-wide level. And then our internal service funds would work the same way. But what I'm pointing out here, the net position is the difference between the, in this example, the assets minus the liabilities minus the deferred inflows. And then we have three categories, and I used a mnemonic run for that: restricted, unrestricted, and then net invested in capital assets net of related debt. So if there's some debt associated with a particular capital asset, since that debt would be a subtraction as a liability, then we report that part net down here so that we can see what part of the net assets constitutes investment in capital assets when there's debt associated with it. Restricted means that it has some external purpose. So we issued the debt, let's say, and we promised that we would use those funds to, fund improvements in the water utility or something. Well, that money's restricted when there's a debt covenant associated with that. Notice, guys, for our proprietary funds, same thing for government-wide, there are only three categories of our net position. For our fund balance, we talked last time, there were 5 categories, okay? Well, there's actually 6 categories, or 2 broad categories, and then in one of the categories, there's 5 subcategories, I guess is the more accurate way of saying it. But we had what? We had non-spendable, things like inventory. Then we had spendable, and we had restricted, which is the most, the largest constraint on our net assets. Then we had what? Then we had committed, where the highest decision-making authority has set aside that money for some purpose, either through some sort of legislative action, or it could be that even though it's not necessarily the highest decision-making authority, it is nearly impossible for the government to get out of that commitment. For example, if a government orders something special order, okay, and they have been having that built per specifications, and the contract is such that we're going to have to, purchase that item once it's completely constructed for us, that could be a constraint large enough that would kick it into the committed category. But for the most part, we're talking about, the legislature has earmarked those funds for a particular purpose. That would be committed. Assigned means that the city managers have made a decision as to how that money is going to be used. And then we have unassigned. So we have what, just to repeat, we have restricted of our spendable, we have restricted, committed, assigned, and unassigned as our subcategories. Okay. Okay, good. And unassigned means that it can be appropriate for whatever purpose they've decided they want to use that money for. Okay, all right, good. Now you come over, but that's not what we're seeing here. That's for our governmental funds and our fund balance. Here we just have the three. Now, when we take a look at the proprietary funds, this is very, very similar to commercial. When I'm teaching my students a CPA exam, this is what I tell them. Hey, you've got to know the way the income statement, the chunks of the income statement, right? Because we have what? We have our operating section, operating revenue, minus our operating expenses. Difference is operating income, operating loss, whatever, if it's a negative number, okay? Then we have what? Then we have non-operating items, and classic non-operating items in commercial and in the proprietary funds, which follow full accrual, very similar to commercial. Interest, revenue, and expense are common examples of non-operating purchases of equipment. Or I should say not purchases for full accrual, that would show up on the balance sheet, but proceeds from the, gains and losses, not the proceeds, but the gains and losses associated with selling a capital asset would also be an example of a non-operating. And then unlike commercial, for our proprietary funds, we kind of stick the statement of retained earnings piece down at the bottom of the statement of revenues, expenses, and change in fund balance by showing at the beginning, net position, add the change, subtract, add a gain, subtract, add positive change in net position, subtract a negative change in net position, and that yields you the ending balance. And again, net position is sort of like our retained earnings. And of course, we don't call out the categories here. We say that the categories for the of the ending balance for the statement of net position. And then for our statement of cash flows, only the proprietary funds prepare a statement of cash flows. Only the proprietary funds prepare a statement of cash flows. What I find interesting is that GASB requires the direct method. Okay, it requires a direct method, and we're going to study this a little bit more, but I actually prefer the government version of the statement of cash flows, not because of the direct method, that doesn't do that much for me. But what I prefer is the way certain things are handled. For example, interest is going to be put properly into the financing activity category on the government version, whereas in the for-profit version, interest is up there in the operating section. Meanwhile, interest is often a non-operating item in a income statement of a for-profit entity. So I find that the government version a little more meaningful for me, a little more useful for me than the for-profit version, which is stuck on net income. For-profit accounting is all about net income, and then that ends up affecting the statement of cash flows. Anyway, we'll talk more about this in chapter 7, but you can see that we have similar categories that you would see in a commercial operating. Here, though, we show non-capital versus capital related financing, and we put financing before investing, which is also different from commercial. And then we have our investing activities. And again, interest from investing below is sort of where it belongs. Now, the interest received, cash interest received, is now, in my opinion, where it should be for government, for-profit as well in the investing activities. And then we still have to provide a reconciliation like you would in the indirect method, but look at how much better this is. We deal with what? we reconcile from operating income. Again, operating income coming from that first part of the statement of revenues, expenses, and changes in fund balance, starting with operating income up here is much more mature than starting with net income. And then you have to do silly things like including interest, revenue, and expense up in the operating. No, they're where they belong, in the financing and the investing. And then we can just go ahead and talk about the changes in our current assets, adding back depreciation and whatnot, like we do for a commercial version of a statement of cash flows. Anyway, I'm kind of digging deeper into my lecture for chapter 7 when we get to this, and we'll get more detail on this. And I'll have some slides that will go into the detail of the preparation of the statement of cash flows for our proprietary funds, enterprise fund, internal service fund, only fund categories that prepare a statement of cash flows. Okay. Again, our internal service fund is where we are providing services to other governmental funds. And they show this little graphic down here with this motor pool. If we have, city vehicles, police cars, let's say, often those are handled at a central motor pool, and that activity would be accounted for in the internal service fund. Carmen, is there a central motor pool for police? Are you able to tell me that, or would you have to kill me if you tell me that?
No. It's, we have a central shop, that actually, does it not just for the police, but it outfits, for all the vehicles.
So there is a motor pool, and they would be an internal service fund. I didn't quite hear all that.
Actually, no, let me see, hold on, actually, I can tell you right now.
It's okay. I know, you don't walk around every day kicking tires on on police cars.
Well,
Yeah.
but yeah, I don't think it operates.
Yeah.
Sorry. We do actually have like fleet central shops. It's one of the departments that our group deals with as an internal service, and so they do both maintenance, and they also provide like fuel for our central agencies. Sorry,
Okay.
Neuro Carmen. Yeah.
And the accounting is used in internal service fund account.
Yeah. It's a department that I'm familiar with, Carmen, so that's why I thought I'll just chime in. I'm
Yes.
sorry, Professor Lord, what was that?
And I'm thinking they would use internal service fund accounting.
Yes, it's one of our internal service fund accountants, called Fleet and Central Shops. Yes.
Oh, okay, good. And we'll get more into that stuff. And now we know who to turn to when we get to that stuff.
Oh, geez. Oh, sure. Okay, bye.
Thanks.
Mhm.
Okay, good. Enterprise funds, we've talked about some of those. It's also something important about internal service fund. Internal service funds are not there to, raise a big profit either. They're pretty much operating to cover the cost. And I share that because I was on an assignment years ago where they asked me to do some work looking to see if there were any indications that essentially state and local governments were using federal funds inappropriately. And so what we did was we worked with some of the inspector generals. Inspector generals are over federal agencies. President Trump just fired a bunch of them, but they are tasked with looking at different government programs, looking for fraud, waste, and abuse. And what one of the inspector generals had done, and I forget which one it was, maybe it was Department of Labor, I can't remember. But anyway, what they did was they looked at in those days, they called it retained earnings instead of net position. They literally called it retained earnings. And they looked at the retained earnings of internal service funds to see if there was an accumulation. They did a trend analysis to see if there was an accumulation of the retained earnings in the internal service funds over time. And if they saw that, then they dug down deeper to ask, well, why? Why are you accumulating retained earnings? Because profit is not an allowable expense at the federal level. They should pretty much be covering costs. And so they literally were able to recover some federal funds from some of these entities that were charging government programs to accumulate retained earnings in their internal service funds. That's not an allowable expense. So what we did at the GAO, once I kind of sat down with the IG, again, I think it was labor, what I did was I went ahead and blew that up into suggested analysis that could be done at the government-wide, at, full federal government level, by all inspector generals, was the recommendation that they do that sort of an analysis to see if there was an opportunity to recapture some federal funds. So that net position, that bottom line should, it's okay to have a little bit of a positive, but it should stay fairly flat over time. From a federal standpoint, there's no reason to be raising profits in these internal service funds. Enterprise fund, water utility, pretty much user charges is the way those are paid for. And again, when we roll that up at the government-wide level, that'll be at the business type activity column at the government-wide level. Okay. So only that 3 there is a big 3 to remind us that only the proprietary funds prepared the statement of cash flows that we were looking at. So it's statement of net position, a balance sheet, the statement of revenues, expenses, and changes in net position, the income statement, okay, and then the statement of cash flows. Okay, let's look at our fiduciary funds. There are 4 of those: the custodial fund, the investment trust fund, the private purpose trust fund, and then pension trust fund. And by the way, we're going to look at, it's kind of peruse through City and County of San Francisco to see which one of these you guys may or may not have here in a little while. But we take a look, and when we talk about these fiduciary funds, full accrual accounting, capital assets would be recorded, long-term liabilities. Additions are reported on the statement of fiduciary, statement of changes in fiduciary net position, like the income statement. Additions are sort of like revenues, okay? Deductions are sort of like expenses, okay? And again, we would have the statement of fiduciary net position, which is the balance sheet, and the statement of changes in fiduciary net position, which is like the income statement. Keep in mind, as we've stated a couple times now, the fund financial statements, the fund types, are not reported at the government-wide level. We don't report those under the operational accountability focus. As I've mentioned, the fund financial statements are required to use the approach of the assets plus the deferred outflows minus the all liabilities, current and non-current, minus the deferred inflows. That difference is net position. That's the approach that we are required to take for our fiduciary funds. So I embedded a question here. And by the way, we're going to go through the chapter 2 practice exam here tonight as well. But the following for the presentation statement financial position for fiduciary funds adheres to the format, adheres to the following equation. And we just saw assets and deferred outflows of resources minus liabilities and deferred inflows of resources will equal that net position. And that same format is used government-wide. It's required, and it is suggested, preferred by GASB that it be used for the proprietary funds. And I think most governments take that preferred method. Okay, so again, we see our assets, you typically don't see things like buildings and things in these fiduciary funds. They tend to be more of a current nature, although it's current and non-current. And then you have investments, by the way, carried at fair value. Again, notice how much more of the commercial type approach that we take for these fiduciary and these proprietary funds. Okay, and so I think you'd want fair value to assess, the pension fund. Now, again, is an example of one of the fiduciary funds. Again, these resources don't belong to the government. These resources belong to the government employees and retirees, but the government has a fiduciary responsibility for these, and so that's why they're reported at the fund level following a fiscal accountability approach, but they're not reported at the government-wide level using an operational accountability focus. Okay, and then you have your liabilities, and then notice the difference between the liabilities and the total assets are going to be the net position. And that's taking that, a format that we talked about where we're showing the bottom line is the difference between the assets and liabilities. Okay, on our statement of changes in fiduciary net position, which is like the balance, which is like the income statement, we have additions, which are like revenue, both employer and employee contributions. Do you all contribute? You're all CalPERS, right? What are you? Are you CalPERS? No.
Some people are in CalPERS, but we have our own, San Francisco employee retirement system. So most of us are probably in that.
Okay. And so it used to be that just the employer contributed, right? But in government, but over the years now, both employers and employees, the plan members contribute. Government's the only place I know of left to get a pension. Most private entities, it's defined contribution plan. Hey, you put so much in and they'll match that, sure. But what you get out of that is entirely dependent on the performance of that investment, right? Pension, it's defined benefit. You follow the rules, you contribute, and then you're supposed to draw out so much. Yeah, federal government, if you're interested, is a combination. So you have the federal employee retirement system, in which there's sort of what they call the thrift savings plan, in which you put money in, the federal government matches, but it's like a defined contribution plan. You get out based on the performance. But there's also a pension piece that is, predicated on how long you work. So if you work, 30 years, you get 30% of your pay when you retire, and then you get of your high 3, and then you get, the amount of money that's consistent with whatever you put into the defined contribution and its earnings and performance over the years. State has a defined, CalPERS is a defined benefit plan. It's a pension. And so you get an amount based on the formula of what you had put in. But it used to be all, back in my dad's day, that's what you got. You got a pension, and your employer, carried that burden of making sure that you were going to get whatever you had coming to you as you retired. That's becoming very, very rare these days. The line cross between defined contribution and defined benefit plans, probably about the late 80s, something like that. I don't have a precise year, but the late 80s, more plans. Before that, more plans were benefit than contribution, and that line crossed in the late 80s, and now the vast, vast majority are now defined contribution plans. Yeah, so I don't know what that's gonna mean for future generations, but that's the way it is nowadays. Okay, but again, notice, we have our increases in our, we have the contributions, and then we have our investments and the results of those investment earnings and whatnot. Those are all considered additions. Deductions, the big one being benefits, obviously. And then if there are some refunds or administrative expenses, those would come out. And again, we use that combined statement of retained earnings and income statement approach here, where we kind of stick the beginning balance, what's the change, and that yields the ending balance, which of course rolls up to the statement of net position, the balance sheet. Different types of funds. Custodial funds are basically when the government keeps track of resources that are going to be distributed to some other entity. For example, counties often will, when you pay your property tax, I'm sitting here looking at my property tax bill, which is going to be due pretty quick here, and I'm, oh gosh, I got to pay this thing, right? When you write that big old property tax, you don't send it to the city you live in, you send it to the county, right? Is where you pay your property tax. And then when you pay your property tax, you pay it to the county will account for the receipt of that in the custodial fund, and then they'll turn around and hand that money to the appropriate city wherever those property taxes were assessed, and they typically hold a little bit back to pay for any administrative expenses and whatnot, but the large majority of that money should be going to the cities within that county. Okay, at least that's how most jurisdictions work, and I'm in Alameda County. I know it works that way, as I'm looking at my Alameda County secured property tax statement sitting here, and I live in Hayward, right? Okay, investment trust fund. This is where the government will keep track of investments, not its own investments. If it was an investment held by, say, the capital project fund, that would be accounted for in the capital project fund, or more likely, probably an investment held in the debt service fund, that would be accounted for in the debt service fund. In our fiduciary fund category, the investment trust fund are those investments that the government is holding for entities outside of the government. For example, there could be a county investment trust fund, and that county investment trust fund would keep track of the investments that it's doing on behalf of, say, other cities. It would be in the county, it would be accounting for that in the investment trust fund. It is a fiduciary fund. Again, it's not investments that belong to the government entity. It's those that it's managing on behalf of other entities outside of that primary government. Private purpose trust fund. This is often things like, I've seen examples, sometimes there'll be a private purpose trust fund for an entity that is providing funds to send kids that maybe their parents were injured or killed somehow in the line of duty, like maybe police officer or fire person or something. And it's really a private entity that's doing that, but the government has made a decision that they will go ahead and manage those funds on that behalf, since it's, dealing with those that are civil servants and whatnot. That might be accounted for in a private purpose trust fund. Okay, and then pension funds, again, we've sort of mentioned that. That's where we're going to keep track of the pension assets for the employees of that government, where the government is actually running a pension fund. Okay, so we saw this earlier, but just remembering the different categories of funds, the fund types: governmental, proprietary, fiduciary, the fund types: general, special, random fund, debt service fund, capital project fund, permanent fund, the internal service fund, the enterprise funds, and then we just went through our fiduciary funds. Remember, that's at the fund level, and then we take our governmental funds plus our internal service fund, and we roll that and consolidate that up into the governmental activities. Enterprise funds come into business type activities, and our fiduciary funds are not reported at the government-wide level. Again, full accrual accounting, economic resources measurement focus for our government-wide statements under the operational accountability focus. For our proprietary and our fiduciary funds, full accrual economic resources, the only one that uses modified accrual, current financial resources measurement focus, in which is no fixed assets, no long-term debt, no depreciation, all that stuff is only in our governmental funds. So when we go to consolidate, we will have to do some conversion from the modified accrual to the full accrual accounting for our governmental funds. Okay, therefore we have to have and we're required that little arrow, okay, that we saw on the model. We are required to show the users of the financial statements how the fund balance reported for all our governmental funds ties to the net position in the governmental activities column. And we have to show that both for our balance sheets, okay, statement of net position, our balance sheet to statement of net position, and for our change in fund balance for our governmental funds to the change in net position. So we not only reconcile the balance sheets, we have to reconcile the income statements, and we'll spend more time with this as we move along in later chapters. Chapter 8, I guess. Okay. All right, we've talked about this, and I'm just going to quickly flip through these because I think we've spent some time with this now, and it's not necessary to repeat all that. Now, major funds. Okay, let's talk a little bit about that. Now, we're going to dig more into the annual comprehensive financial report for city and county here in a couple of minutes. But San Francisco has only the general fund as the major fund. All other funds are shown as non-major, although we do have detail providing the detail of the non-major funds and combining statements, and we'll take a look at how that works. But how do you determine if a fund is a major fund or not? So there are two criteria, okay? Well, maybe three if you want to look at it that way. First off, the general fund is always a major fund. You don't have to evaluate the general fund to see if it is a major fund, okay? It's all the other funds that you have to determine if they are major funds. And so what you do is you go by category, okay, of funds. So you will take what? The total assets, liabilities, revenues, expenditures, and you do it for each line item, guys. You don't add everything up. You do it for each line item. The only line item that you don't do the analysis on is the fund balance, but you do the analysis for all the line items. You add all of those together, all the assets. You multiply that by 10%. And then you go through and you'll compare for each one of those line items for each one of those governmental funds. And you do it for the enterprise funds as well to see if they meet the 10% criteria. If they do, then they have to go through a second test. And that second test is a 5% test in which you add up the total of all the governmental funds and all the enterprise funds, add that big number together, multiply that by 5%, and then you go through, again, line item by line item, every line item except fund balance, to see if they meet the 5% test. And if they do, then they're considered a major fund, and they would be reported as a major fund alongside the always major fund, the general fund. Okay, now I know that's like, huh? Can you say that again? And some of you may be involved in these determinations, and so maybe what I said is like, yeah, We got it, John. But I'm going to go ahead and I want to make this a little bigger. Made it too big. Yeah. You know what I do? I'll just scroll across when I come off the page. Okay. Now, you know, maybe try to read a little bit closer. This is from the book, but I can't seem to make this slide the right size so that it's easier to read. But so try to take a look at it. Okay, but what we have here is an example, and this is from the textbook. So I don't know if it's still on page 38, but if you got the textbook, you can look this up a little bit more detail on your own. But notice we have these different funds. And again, the general fund would already be a major fund. So these are different governmental funds, and they're going through and they're trying to decide whether or not these are major funds. And notice we have, and I said line item, total of line items. We have assets, liabilities, revenues, expenditures. You don't do the category for the analysis for fund balance, okay? But you look at the road fund and you see its assets, okay? And then you run it against the, let's start with the capital project fund. I think that's a better way to start. The capital project fund, that 19 million, whatever, and you look at it and you run it against, and you can't see it in this example, but they took the total of all governmental funds, multiply that by 10%, and they got this 4492627. So the capital project fund is clearly meeting the 10% test, but it also has to meet the 5% test, okay? And when you look, yeah, it's, I'm going to use a Hayward term, it's hell of meeting the 5% test as well. So the capital project fund is a major fund, and it would be listed alongside the general fund as a major fund. And I don't have to do anything else to see if the capital project fund is a major fund. Now, when you look at, and let's go ahead and look at the debt service fund. When you look at the debt service fund and you look at the assets, hey, it's not passing the 10% test. I don't have to look at the 5% test. If you're not passing the 10% test, the 5% test doesn't matter. It's not a major fund based on assets, but it's not dead yet as an opportunity for a major fund. I keep going, and when I get down to revenues and I compare it to the 10% for revenues, they took all the revenues of all the governmental funds, add them together, multiply that number by 10%, that yielded 6,073,000. And when I look at that, yeah, it's meeting the 10% test for revenues. Does it meet the 5% test where I add all of the revenues for all of the enterprise funds and all the governmental funds and multiply that by 5%? Yeah, now it's meeting the 5% test for that. So it is a major fund and so forth. And it doesn't have to meet it for all of them. It only needs to meet it for one category, line item category: revenues, assets, liabilities, revenues, expenditures, expenses, not fund balance. You don't do that analysis for fund balance. Question? Are any of you involved in determining major fund status? No? Okay, it's a mathematical thing, right? Okay. All right, good. So let's just go ahead and let's take a look at, you see the major funds here. Okay, these are all major funds. And then they have this other governmental funds. These are non-major, right? Now, when you look at non-major funds, you get this total here, this 359. You see that, right? Now, by the way, notice the reconciliation here. We talked about that earlier. Okay, that reconciliation where we take fund balance and reconcile it to the net position for the governmental activities column. Okay. And we talked a little bit about that last time, but notice they add in the capital assets here because we don't have capital assets at the fund level. we do at the government-wide level and so forth. And again, we'll talk more about this later. But right now, I'm focusing right here. I say later, chapter 8 or so. But right now, I'm focusing on this total of the non-major funds in this little example. And then when you start getting down to, and this is optional, GASB does not require, so we're off of the chart, the GASB chart. This is not even required supplemental information now. This is a optional way of providing information on which GASB hasn't said they, but the combining schedules that will show what constitutes a non-major funds. And so you can see here by category, and then they even call them out by the specifics of what they are. And these all total up to that total non-major fund category, the 359. They labeled them as other. Now, when I say it's optional, I think we looked, correct me if I'm wrong, Carmen, but we looked, and I think in the GFOA, Government Finance Officers Association checklist, I think combining schedules were listed as something that they would expect to see under the GFOA suggestions, right?
Yes.
Yeah. So, and we're going to take a look because I did see them when I looked around at San Francisco. We'll take a look at those here in a couple minutes. Okay, good. We've already talked about the reporting of capital assets at the government-wide level and at the proprietary and fiduciary fund level. Same thing with long-term debt, long-term liabilities. Okay, so I thought this was useful and that, you know, it gives you something to look at as to the measurement focus and basis of accounting for the various funds. Okay, budgetary information. Now, this is that bottom box required supplemental information. Budgetary comparison schedules between the adopted budget, the amended budget, and actual. Now, you have to show those columns. Providing the variance is optional. Again, optional under GASB requirements. I think GFOA expects you to have a column there for the variance, but that is optional. Okay, and you can see how that looks there. That's pretty self-explanatory. Okay, so what I think I want to do is spend a little time looking at the city and so let me go to full screen. Okay, and this is the government-wide statement of net position. Okay, City and County, San Francisco, right? And notice the total assets, total current assets, total assets, the deferred outflows. And I checked, and when you add the total assets and total deferred outflows, you get 19,892,511. And then you go ahead and you come to the liabilities and then the deferred inflow. And when you add these two numbers, you get 14,078,515. And when you get the difference between those two, you get a total net position of 5,813,996. So that made me feel good when that happened. Notice, remember we had the mnemonic run, restricted, unrestricted, net invested capital assets. Okay, so I'm just kind of showing you you know, which you probably already know, there's our upside down statement of activities. Okay, using what? Using a program approach primarily, but notice, and we remember we have primary government and component units. Using a program approach here, okay, and then all of the revenues at the bottom. Remember we talked about that. There's our governmental fund, again, general fund. All of these would be non-major funds, okay? And I did take a look, but I forget what page it was on, and I'm not going to bore you with me searching all over for it. Just rest assured that the other governmental fund column, okay, and if you want to check it on your own, you can, does tie the combining statements, okay, which come later, okay? There's the reconciliation that we've been talking about. Business type activities, okay, all the different enterprise funds. I guess many of these, you had more than just a few major funds here. You had a lot of, they were all considered major funds here. And then our internal service fund. Okay. Oh, I wanted to show you something. I know I mentioned it last time, but I want to point it out again. On our general fund revenues, expenditures. Notice, guys, we're taking I always forget that word, a character. Thank you, John. A character approach, showing if expenses are for current purposes. Character is what is the period that it'll benefit, the current period. Debt service is telling you, hey, it's going to benefit future periods, both the principal retirement. So when you pay off a bond, that's treated as an expenditure at the fund level, for example. The interest is expenditure, just like it would be full accrual. Capital outlay, but notice we're showing you, well, yeah, we're treating it as expenditure, but you can know that, you know, capital outlay is going to benefit more than one period. And then we have sort of this line item here of excess of revenues over expenditure. And notice, guys, that I find this interesting because this is like the operating revenue section, okay? And the general fund was showing an excess. The total of all the other governmental funds was showing a deficit for whatever. Any thoughts on what the reason for that was? Okay. And then our other financing sources and uses, transfer in is a source. Issuance of bonds, okay, would be a source, right? Long-term debt proceeds, and then the transfers out. And yeah, that's typical that the general fund is going to be transferring a lot of money out to the other funds, okay? And then you can see that sort of, you know, bottom line here. Notice we take the net change in the total fund balance for the governmental funds, and we reconcile that to the net change in net position shown on that statement of activity. So that's what that reconciliation is supposed to do. Okay, and then we have all our enterprise funds. Notice, guys, they take the difference approach, right? Just like we saw for the government-wide, the difference between the assets and liabilities, deferred outflow and inflow. Notice, guys, you know, operating revenue, operating expenses, right? Operating income, non-operating items. Okay. And then statement of cash flows, right? Direct method is being used here. Direct method. We have operating, non-capital financing, capital related financing, investing, right? And then the reconciliation, which is sort of like the indirect approach, but the more mature way of, in my opinion, of doing the indirect approach is to start with operating income, which we do. We take that, for example, just looking at the airport, 424,834. Where's that number? You get that off of the right here, 424,834, that number right there. Okay. All right, good. One more thing I wanted to look at before we take a look at the test. And it's worth remembering. Oh, couple things. 230, 229. The okay, 230 is fine. Notice the variance. That's not required. Required supplemental information is this: the original, the final budget, and the actual budget. But the variance, that column is optional, but apparently the GFOA thinks it's important. And then something that we really didn't hardly say anything about, but I do want to make sure.
Oh, I have a question.
Uh-huh.
What is the column actual budgetary basis? What does that mean?
It's the actual using budgetary accounting, and we haven't talked about. So this is the budgeted. This is the actual using budgetary basis of accounting. For example, when we actually encumber something, we would be showing that in this column.
Okay, so it's encumbrances.
No, it's just think of it as the actual, but we use budgetary basis of accounting. So where it really starts to become more relevant is not so much in the revenues, resource inflows, it's more on the outflows. That if you actually encumber something, you would treat it as though that money is now actually gone, as opposed to that you actually paid it out, you've actually encumbered that money. I believe that's what it means. Does someone want to correct me on that? Yeah.
So actual budgetary basis means our actual expenditures and our actual revenues that we have earned or incurred.
Correct, except my understanding of this is that if you encumber money, it would be included in, say, that 45,313, 312, excuse me. Even though you hadn't recorded as an expenditure yet, because you have encumbered that money, it would show up in that actual column. I think that's what it means. Does somebody want to correct me? Feel free to. I won't be offended. So there's two different things that happen. You actually spend the money, right? Where you debit expenditure and you credit, say, a voucher payable or cash. But then you can also encumber money, in which you go and you debit encumbrance and you credit, and ultimately that comes out of fund balance assigned. And so even though you haven't actually recorded that as an expenditure yet, you've encumbered that money. And so it's reduced the fund balance through the encumbrance process. And that would be included in that number, even though it's not officially an expenditure. it is a use of the fund balance resource of the current financial resource. And so it ends up reducing fund balance and it would be rolled into that column.
Okay, so it consists of both encumbrance, actual revenues, and actual expenditures.
Yes.
Okay,
Yeah.
thank you. Got it.
And they have to do that because it's kind of hard to explain without having shown you the whole encumbrance process and how outstanding encumbrances get closed into fund balance. Once you see that, then you'd understand why you have to do this part. So you can't fully, if you don't fully understand this yet, don't feel bad because we haven't dug deep enough yet to get a full understanding of it. Okay, all right, good. And then what I wanted to show you is 229. No, I showed you the variance. Oh, 287. Because we didn't say hardly anything about it, is that last part of the comprehensive annual comprehensive financial report, the statistical section. And man, there's all kinds of things in here. Okay. And you can probably become, if you master all this data, you can become mayor, I would say. Okay. Okay, good. So with all that, there's the trend lines and stuff. What I want to do is look at, so you can kind of see, hey, if I was going to be tested on this information, when we go through and we do our midterm together, what's it going to look like? Okay, and that's the purpose of this practice midterm, which is, you see the file name is quiz, but it's listed as practice midterm for chapter 2, and you have this on e-learning. Okay, so let's take some time. This is pretty easy. Which of the following funds all use current financial resources measurement focus? You look at a question like this on an exam, you say, hey, got to be the governmental funds. They're the only ones that do that. So any question, any choice that has anything other than a governmental fund is wrong. So B got the internal service, C got investment trust fund, pension trust fund, and D, so A's got to be right because it's the only one that only contains governmental funds. Okay. Which of the following of Chessie City would be considered to form the governmental activities column? It's what? It's governmental funds plus the internal service fund. So any question that is showing me any fiduciary fund or any enterprise fund can't be correct, right? And so here we only have 3 choices. General fund, yeah, as a governmental fund. Debt service fund, capital project fund. Those are all governmental funds. They're going to go in governmental activities column, okay? 4, which of the following is the measurement focus and basis of accounting for the government-wide? Full accrual, economic resources. We saw that a number of times. The measurement focus for the governmental funds, current financial resources, measurement focus, right? Okay, this one, see, I want to put it back in tab because I think it's useful to kind of show you. Yeah, what might be a good way to kind of attack a question like this? Okay, so we have this Hannah City, okay, and this Hannah City has 1,500,650,000, okay, and I'm going to label that as U for unassigned. I guess I'll put that U here, okay, for now. Okay, but then they tell us some things about the total. And what I'm going to do is I'm going to decide, okay, is it committed? Is it restricted? Let me start with restricted. Is it restricted? I guess I can put, I'll put committed. and assign down here, okay? And whatever I'm left with that I take out of the unassigned will be the unassigned when I use my calculator for this, okay? So we start to look and they say the budget officer decided to set aside 405,000. Well, if a government employee, a budget officer, okay, is making a decision as to how money should be programmed, that money is assigned 405,000. And so what I'm going to do when I'm doing this problem is I'm going to subtract that here because I want to find out what's unassigned because I see the questions asking me that. You know, and I look at all the choices, I'm going to have to come up with the unassigned to be able to answer this correctly. Then they said unspent restricted drug enforcement money. Well, thank you very much. Since you're telling me it's restricted. Now, they're not asking me to keep track of restricted here, but I'm going to do it anyway. Right? And I take that out of there because it's restricted, it's not unassigned. Okay, and then they say the county's governing board pass a resolution. Well, that's committed money. If the governing board, the highest decision-making body, makes a decision that becomes committed, even though they're not asking me committed, I'm partially teaching here as well as answering this question. That's 500,000, okay? And then when I do the math and I take all of these off of here, I get 585,000 as the unassigned and 405 as the assigned. That's the way to answer a question like that. Of course, you had to know the definitions, and we went through that last time. Okay. Which of the following does not affect the excess of revenue over expenditures? Remember, we had revenues, we had expenditures. That gave us the excess of revenues over expenditures. Hello. And then we sat there and we had what I was sort of analogizing, is that a word? To the non-operating section of the statement of revenues, expenditures, and changing fund balance, which was other financing sources and uses, right? And so, and we said that there are what? There are two other financing sources transferred in long-term debt proceeds, one other financing use transfer out. Okay, so other financing source transfers in from the internal service fund, yes. Purchase of capital asset is an expenditure. Proceeds from the issuance of 6-month note is a like a revenue, okay, for our proceeds from the issuance of 6-month note payable. It's 6-month note payable. So strike what I just said. That's not a revenue. 6-month note payable, okay, is a short-term instrument. Short-term, yes, we have what? Current assets. So it would have to have been a year or more for it to have been treated as another financing source. So it's the 6 months part that makes that one not the correct choice. Special item is not an other financing source in use. So what did I do? I jumped down, didn't I? So, okay. Excess of revenue over expenditures, purchase of capital assets and expenditure, salaries is an expenditure, property taxes is a revenue, other financing sources is down in the other financing sources section, okay? Now number 8, which is another financing source, transfers and long-term debt proceeds are the only thing that are other financing sources. So you see that transfer in from the internal service fund here. And I've explained why B is not considered another financing source because it's a short-term instrument, and special items are not considered other financing sources. Which of the following does not appear on the statement of revenues, expenditures, and changes in fund balance, which is the operating statement? Receivables are on the balance sheet, not on a thing that's like an income statement. Expenditures for debt service, capital outlay. We saw that on San Francisco's, right? Beginning balance, remember they do that thing where they combine like the statement of retained earnings with the operating statement, the statement of revenues, expenditures, and change in fund balance. Which of the following funds would be reported as a fiduciary fund, private purpose trust fund? The internal service fund is a proprietary fund. Permanent fund is a governmental fund, as is the special revenue fund. Modified accrual, only governmental funds use modified accrual, and the only governmental fund listed here is the capital project fund. These I took from the book, okay, just to give you a sense of how I've set up some questions in McGraw-Hill Connect that are very, very similar to some of the ones we see in the practice midterms, but now you're seeing it here as I lifted it out of the textbook. So which of the following accounts are identified at the end of the fiscal year would be classified as restricted when an entity outside of the government says, this is how you will use these funds? That money's restricted. And the federal government is not part of the city government, right? So if the federal government says you'll use this money for this particular purpose, that money's restricted. Resources the city manager set aside would likely be assigned. Significant amount of inventory is the non-spendable. Endowment resources the city maintain in perpetuity is probably not going to be accounted for in a governmental fund. Therefore, it's not going to meet the category. What made it wrong is it might very well be restricted, but it's not a fund balance. It's going to be a net position. So that one was a little more tricky. Number 3, they want to see which are the major funds. So what you do, can I write right here? Yeah, okay. Is you take the totals down here and you multiply this one by 10%, 0.10. You multiply this one by 0.05, okay? And when you do, I don't know if I feel like doing the math on this, but when you do, you get 2.63 something for the total of the governmental funds. And then you get, you know, I don't know, whatever this 0.05 comes out to. But when you look, it ends up that the general fund's always a major fund. I didn't have to do any math there. And I look down and I'm like, okay, well, I can't eliminate a choice that way. But when you go through this, it turns out that only the library fund also met the requirement. And that's why that's the right answer. And you can take a look at that, but you can play with that on your own. But trust me, I looked at it earlier and it's going to work out. Okay. How does the GASB recommend government report budgetary information? That was part of that required supplemental information stuff that we looked at, right? And then some of those variance columns were optional. Okay. And this one, just asking you basis of accounting for the governmental funds, modified accrual. Everybody else uses accrual, the proprietary and the fiduciary. Okay. Any question about tonight's material? Okay, guys, we're going to hit the ground running for chapter 4 next time, 4A and possibly 4B. 4A, focusing on revenue recognition. 4B, dealing with some of that encumbrance discussion and expenditure discussion that we tapped on a little bit here earlier. Okay. Any questions, guys?
Hi, Professor. I have a quick question.
Sure.
Could you please maybe provide some more live example so then we can really try to understand the net position categories? Like you mentioned net investment and capital assets, restricted and unrestricted. Yeah, something like that pretty much in your head. You use it as the best example. Thank you.
Restricted means that a third party has told us how we will use that money, or we've contracted with a third party. For example, let's say I issue bonds, and when I issue bonds, I say that those bonds will be used to build some sort of make improvements to some sort of water facility or something. I must use that money for the water facility. I have to use that money for that purpose. So that money is restricted because I've made a covenant with the bondholders that that's what I'll use that money for. The federal government gives me a grant of $10 million and says I must use it to assist low-income individuals, let's say. That money is restricted because the federal government, the grantor told me this is how I am to use those funds. So if you want a specific example of, well, I was involved with something in which they gave money and that's what it was for, that I can't do because I don't work for a state and local government, but that's the nature of things that would fall into that category. Hello?
Yes, thank you. And then the net investment.
Yeah, invested in capital assets, net of related debt. So let's say I have a building, and let's say that the government has a building. Okay, and this is in my assets. Right, building is an asset, and let's say it's $1 million. And that's all the assets the government has, okay? But then I have a bond payable that I'm going to abbreviate BP. And let's say the bond payable on that thing is, and I'm just making the number up, 600,000. Now, when I get to my, these are my assets, my liabilities, right? Bond payable is a liability. We're talking government-wide, full accrual accounting.
Mm-hmm.
I get down to net position. Now, the total net position, right, which you can clearly see, is 400,000, isn't it? But I would be required to call out, capital assets net of related debt, the N capital assets. Let's see. Sometimes I feel like GASB wants to pay us by the word, but capital assets net of related debt. Excuse my poor handwriting. That's 400,000, right?
Mm-hmm.
So we're showing you, we're partitioning out, and just to kind of maybe where I should have started this example. It's not letting me write assets up here. Assets. Let's say I had cash, and I have cash of just say 500,000. Then, and assuming, of course, that cash is unrestricted here. Okay, so now my total is what? Total is going to be 900,000. And I would have, again, assuming the cash was unrestricted, I've had unrestricted here that I'd be required to call out at 500,000. Does that make sense?
Mm-hmm. Thank you.
Yeah. Okay. Anything else, guys? All right. Keep up the good work. We'll meet again next week. I'll be putting up these recordings. In the meantime, if you have questions, you know, the office hour is on Thursdays, or you can just reach out. We can schedule a time accordingly. And otherwise, I'll see you next week, and we'll jump into chapter 4, okay?
Oh, I have a question.
Mm-hmm.
Oh, it's about the midterm assignments in general for this class. So I just want to confirm again. So for each chapter's practice midterm that you have in the GGU e-learning, so those we just do those at home. We don't need to submit them in to
We're doing
e-learning.
them now
Yes, we do.
for each chapter, and then we're gonna do the one, I think what we're gonna do, the one that's billed as the midterm
Mhm.
on the syllabus. I think what
Yes.
I'll do is I'll let you guys kind of work it on your own, and then we'll work it together.
Okay. Yes, so far for all those chapter midterms, I usually work on them on my own, and then in class um I'll listen I'll listen to the class to
You work them on your own if you want, and then we'll go
Yeah.
through them together.
and then go through them together in class. Yes.
Yeah. Yep.
Yes. So it's just
But on the day, what'll happen on the day that's scheduled as the midterm date,
Mhm.
what I'll give you won't have the answers. You'll have to sit there and work it, but we'll cut it off after, say, an hour or so, and then we'll work it together.
So we'll work on it in class first,
No.
and then we'll go over it.
Correct. Yeah. You guys will work on it, right? And then we'll go over it together. So maybe like class will start at 6 o'clock, and we'll go over together, and you'll get full credit for it as long as you're there that day. You have to be there that day.
Okay. Thank you.
Okay. Anything else, guys? And don't worry about dates. I know, I'm required on the syllabus to put when the exam is scheduled. We may, if we're running on a time, we may go ahead and push that back. But I'll know a little better after we see how we're doing getting through. We still got to get through chapter 4, which is the big one. Okay, guys. Have a good rest of the night. I will see you next week. If there's nothing else.
Thank you.
Thank you.
Thank you. Bye.
Thank you.
Good night.